Good morning, everybody. Hey, welcome to Monday. It is Monday, June 13th. Hope you guys had a great weekend. As we look back to last week, it was a rough ride on Wall Street. The roughest ride we've had, I think they said since January or March of this year. So we'll continue to talk about that and more when Dave joins us here in just a moment. Before we do that, though, let me just remind you that there's a lot of stuff out there that you and I cannot control. However, you can control how much risk you have in your current portfolio. To discover whether you have too much risk in your portfolio, give us a call at 863-382-0037 to schedule your core retirement design phone consultation. 863-382-0037. With that, we got Dave coming up next.
105.7 Highlands Light FM. That's Vanessa Carlton there. I'm Morning Dave. It's time. Some days I really don't even want to do this just because I hate being the bearer of bad tidings, but we're going to check in and see what's going on Wall Street with a little help from Phillip Statler from Statler Financial Services, who is on the telephone. Phillip, good morning. You kind of didn't want to give this news either this morning, did you?
No, I didn't. It was really, I think I saw where the last week was the worst week we'd seen since either January or March of this year. So not good news at all. And it was just a terrible week.
And it's kind of looking like it might continue based on the futures this morning. Here's why we're both in kind of crummy humor. Friday on the markets, the Dow was down 2.73%. We fell 880 points on Friday alone. S&P was down by 117, and the Nasdaq was the champagne loser of the bunch, down a full 3.5%. Went down 414 points all in one day. And I'm looking at the futures this morning, and we're getting kind of nervous about the Federal Reserve meeting this week, aren't we?
Yeah, I guess that's what's putting the dampers on it, because one of the couple of things I've saw that I've read over the last weekend is that there's concern that instead of the 0.5% increase in interest rate that everybody is expecting, that there's concern that they could raise it 0.75% to even 1%. So, 0.75 would be bad. If it's 1%, that would be, to me, kind of catastrophic to the market as a whole.
I got a sneaking hunch it'd probably not be very good for the employment picture either, because at that point in time, cost of doing business for companies goes up so markedly that then we start looking at layoffs and start looking at employment reduction in forces, which would kind of knock that leg on the stool up that we've been using as being the reason why we're not expecting a recession before the end of the year. I had some numbers came in one of my tip sheets. Considering it's not a particularly fun bit of information, but FactSet did the run. And from March 15th through June 10th, companies in the Standard & Poor's 500 citing the term inflation in their earnings calls, 417 of the 500 companies all mentioned it as being a factor in their guidance. It doesn't matter what line of work you're in. Inflation is messing with our brains right now.
It really is. It continues to get, higher, and I don't see it retreating any. Matter of fact, it could still be getting worse. I mean, it's going to be interesting. I think it's tomorrow or Wednesday we get retail sales. Wednesday we get retail sales, and so that's going to be a kind of a telltale of what's going on in the marketplace, and could definitely put some pressure on the markets that day as well when that number comes out.
Well, on your weekend program, I think you mentioned this as well, but, demand crash. Right now, our retail sales have been going up because people are spending their money and sometimes dipping into their savings in order to keep their lifestyle up, on the presumption that maybe, just maybe, hope upon hope, this inflation thing is transitory and we can catch up later. That means smaller deposits into 401ks and IRAs. It also means some folks are dipping into savings. At some point in time, we start saying, whoa, this crud's going to be with us for a little while, and we start actually cutting back what we buy, and that's when we start looking at the potential for a recession.
That's right, because that's what will cause it. When we quit buying, which that'll be when prices get too high that we can't afford to go buy the stuff that we're used to buying, that puts pressure, because now we stop buying. It's just a trickle effect, right? Just a round robin. And it continues on, and that will throw us into a recession.
It's kind of a domino effect. One thing does the other, and all of us that were around looking at what happened to us in the '08-'09 crash, we know it's a consumer-driven economy. The consumers are going to drive whether or not we go into a recession or not. If we keep burning plastic, we keep spending money, we'll make it through the inflation run. But the problem is, eventually the inflation is going to outstrip our ability to keep on spending, and that's when the potential for a recession starts happening. And your sources have been talking about it happening in 2023. My suspicion is if the Fed goes above 0.75%, well, it might come a little sooner rather than later.
That's right. It could actually come a little earlier. They could kind of do a self-fulfilling prophecy a little early and cause that to start happening in 2022.
Absolutely. After an Armageddon day like we had on Friday, one would normally expect rules of thumb to say, okay, you start going to the rock stable stuff that never changes, always grows roughly at the inflation rate, like, gold and silver and whatnot. Nothing's working the way it's supposed to. I kind of was figuring that Bitcoin and Ethereum, the cryptocurrencies, would be a place where people would hide their money, but even they aren't weathering this storm, are they?
No, they're not. Gold's still way off its high. Silver's way off its high. And then we've got the daggone cryptocurrency. It's way off its high. I mean, it's down another 12.6% this morning. Ethereum's down another 16.5% this morning. I mean, some really low numbers. We've got Bitcoin below 25, almost below 24,000. Ethereum's below 1,300. So everything's getting beat up on that front. So it's almost like everything's going down, nothing's going up. I mean, I'm sure there's a few sectors here and there that are making their way up, but even if you look at the aggregate, the S&P 500 aggregate bond index year over year is depending upon the day and the month, but it's somewhere down between 8 and 10% right now.
So where are the smart money guys putting their money? Stuffing it in a mattress someplace?
No, not really. I mean, they're trying to find they're trying to weave in and out and try to find a few things. I mean, energy obviously is doing well right now, but it all depends, right? If you get the wrong energy company, you can go the wrong direction. So it's a tough call right now, and that's why it's so important that people understand how much risk they have in their portfolio. Make sure they have a certain part of their portfolio absolutely risk-free in terms of protecting their principal. And when we sit down with folks, that's one of the missing keys that we see most of the time is there's not that piece of the puzzle in their portfolio.
And a lot of us took your advice years ago, and we're all glad that we did, looking at the downtech right now, taking a portion of it and putting it in, as you say, some risk-free properties in the portfolio so that while things are down, you don't go down as far as the markets as a whole. I really feel for anybody with 10 years left and they're all vested in equities right now, because this is not a fun place to be at the moment.
No, especially, I mean, you look at a lot of 401k people, a lot of those use what we call retirement date funds. And, if you're 10 years out, your retirement date fund is probably getting hit pretty hard right now.
I believe that. And the ones that ended up taking company stock as a component of their 401k, where they're dominated by one company, I sure heck to hope it was a prospecting oil company, because right now that's the only growth sector that's out there, right?
It definitely seems to be one of the few anyway.
Absolutely. So it was a lackluster, to put it very mildly, day on Friday. We got a Federal Reserve Open Market Committee meeting that runs tomorrow and Wednesday, 2 p.m. on Wednesday afternoon, where we'll get some certainty. And if the rumors are out that they might go 0.75% or maybe even 1% bump on the interest rate, I'm going to assume we're looking at some real serious volatility for the next 2 days, especially with absolutely zero as far as government reports out to affect the economy today.
Well, yeah. I mean, no government reports, no really earnings coming out of any substance, and so we are seeing the red ink is pretty substantial on the futures this morning.
Well, let's quantify it. After a really, really crummy day on Friday, 45 minutes before we open this morning, just how bad is the red ink at the moment, Phillip?
So I've got the Dow down 1.8%. That's like $568 after $800 on Friday. We got the S&P 500 down 2.25. Let me just say that if by chance we end up down 2.25 today and close there, we will close in a bear market. So I ran the numbers through Friday, and we're down 19%, pretty much right on the nose. The NASDAQ 100 down 2.8%.
Poop.
So yeah, not good across the board. And then we've got the other commodities, not good either. Silver's down another 2.1%, down below $22 at $21.46 an ounce, and gold's down 1.5% to $1,847 an ounce. The only thing that's going down that we like is crude oil right now is down 1.5%, $118.89, and it still needs to get down a lot more than that to get us below that $5 a gallon.
Yeah, and that just under 119 is about where we were on Friday morning, so the trend isn't necessarily established. It was kind of a weekend spike and then a retrenchment. Overseas markets, they're having about the same rough time we are over in the Asian rim. They closed down big time. Japan was down over 3%. The Hong Kong market down 3.5% at the close at 6 a.m. China being a command and control economy, they were only down 0.9%. Pretty much the same thing going on in Europe midway through their day. All the indexes are down by at least 1.5% halfway through their day. Stability is what we've been talking about, Philip. There are tools where there's virtually no risk to putting your money someplace, and right now, having something that'll go nowhere beats the heck out of where the equity markets are going. How do I find you?
And they can give us a call at 863-382-0037 to schedule their core retirement design phone consultation, and we'll help them determine if they're on the right track and what their next steps may need to be. And then they can catch the Statler Financial Radio Show this weekend, Saturday, 6 a.m. and noon, and Sunday, 10 a.m. on Highlands News Talk 730 and 95.3 FM.
And we'll be back here together again tomorrow morning with hopefully a little bit of good news. And if it's down less than 500 points, I'll consider it good news at this point, won't you?
Yeah, I think so. Looking at what I see here, yes.
I'll see you then. Thank you, Philip. Have a good day.
You too.
That's 105.7 Light FM and Statler Financial Services, Phillip Statler.
Hey, folks, again, I want to thank you for joining us today. It is Monday after coming off of a rough week on Wall Street. The question is, where are we going today? And we'll talk about that more when we get together tomorrow morning. Hey, until then, have a great day. Bye now.